Welcome, everybody, to the Financial Freedom Fighters podcast. So I looked at our Spotify account and we have a perfect 5-star rating for the Financial Freedom Fighters podcast, but we have 16 reviews. I'd like those review counts to go up. And I'd obviously like to keep the 5-star rating. If you guys enjoy listening to this episode or any other episode, we'd really appreciate the 5-star review on Spotify, Apple Podcasts. Wherever you listen to this, we'll transition into what the episode for today is. And so, ladies and gentlemen, Mike and I are your hosts of the Financial Freedom Fighters podcast, but we were first and foremost and always will be real estate investors ourselves. And we are not just sitting here talking about doing real estate deals and, opining on what's happening in the real estate market. We are actively investing in real estate deals. And that is what we are going to talk about today. I have my first Airbnb, luxury Airbnb, I'll call it, under contract in Northern Michigan. And I want to break down this deal with you all, kick the tires on it, really uncover all of the details. I'll be very transparent about, a lot of what went into this, especially some of the anxiety and the mindset. We'll talk all the numbers. Without further ado, we'll kind of jump into it. So let's take a step back. Mike and I are predominantly long-term rental investors, right? So we buy property, we get a long-term tenant in there that's going to stay 12 months or more, ideally more. And we have a property manager, or I have a property manager. And that is still, I believe, over the long term, going to be the most effective real estate investing strategy. And I think that is where most people should start their real estate investing journey, because over time, it's going to be the easiest, the most headache-free, and it's the lowest risk strategy. It's not without risk, but it's the lowest risk strategy when you compare it to other real estate investing strategies. And that's where I started my career. That's where I'm investing. And I don't plan on changing that as being a fundamental core piece of my strategy, right? Long-term rentals, I think, are the way to go, especially over the long term. It's going to prove to be so. But there are two different strategies when we're talking about rental properties. The second one is short-term rentals, which everyone listening to this is probably familiar with the short-term rental concept. Airbnb, VRBO, you're charging by the night, right? You're charging by the night. So you're going to drive a lot more revenue with that model. But with more revenue comes obviously a much higher management burden and much higher risk. You have people coming in and out of the property potentially every other day, and you have a lot of turnover, a lot of wear and tear on the property. There's a lot of risk in terms of the regulatory environment. We're seeing all that stuff. New York City banned all Airbnbs, right? So a lot of these metro areas are kind of taking a very hardline stance against Airbnb. So you have that risk. And Airbnb also, it's much larger purchases. You're buying nicer single family homes in vacation markets, right? And these are going to be bigger purchases and a much higher upfront capital investment because you have to furnish the place and design the place, right? And you're not doing that with the long-term rental. So there's just added risk there. And then the newer kind of entrant into the market, I guess that's not new anymore, but is the midterm rental strategy, which is somewhere in between. You're renting out to traveling nurses, traveling business professionals, and you're getting them for less than a year. They're maybe on an engagement for a hospital and they're staying there for 3 months or something like that, right? And you kind of get the best of both worlds where you have higher revenue than long-term rentals, but less management overhead for short-term rentals. And that's kind of emerged as a nice strategy. And I'll say this, over the course of my career, and I'm barely scratching the surface, I'm going to implement all of these strategies, right? Mike and I constantly talk about what does a midterm rental strategy look like in Cleveland, because we have the Cleveland Clinic there and things like that. So maybe that's a good strategy that could work there. We've even talked about short-term rentals in Cleveland as well. So just kind of want to introduce this, that there's a lot of different approaches to this. I still believe that long-term rentals are a good place to start, because I would not have felt comfortable with this deal that we're about to talk about if I didn't have the foundation of buying the long-term rentals that I've bought and having that foundation. And so that's kind of the backdrop of where we're at. So with that, this property that I've acquired, or I'm under contract currently, right? And so our scheduled closing date is a couple weeks from now, but I would say, have kind of overcome most of the hurdles to be able to kind of get that clear to close. Like the appraisal just came in a couple of days ago, and that was kind of the last major hurdle. And we'll talk through all these steps. I think there's going to be a lot of value in kind of talking about the life cycle of this deal for you, the listener. But this is an Airbnb. It is a luxury Airbnb. It is a lakefront property in Northern Michigan. And this is one thing that I didn't know, right? Again, me and Mike, big proponents of investing in the Midwest, but I didn't know that Michigan, specifically northern Michigan, around these lakes are such attractive, local, drivable vacation spots for people in the Midwest. And I did not know this. Another point, so I joined the Airbnb coaching program. Shout out to STR legend, Matt McCall-Stillman, who is the coach of that program, who was a guest on the Financial Freedom Fighters podcast. He is a broker, realtor, and he is now an Airbnb coach in Michigan. And he has 30 Airbnb units, and he has a property management company there as well. So he knows Michigan really well, specifically Michigan Airbnb. And the gap in the market that he's highlighted is he has all of these data points of how his properties are performing in these various spots in Michigan. But AirDNA, which is a data service where you typically look at how much a property can do, it's like an underwriting software to get a sense of how much revenue could generate. The data is very sparse in Michigan. They just haven't kind of filled in those gaps. So a lot of the people that would be looking at Michigan are not looking at Michigan because of the lack of data. But because I know somebody that is a local in that market that knows it really well, I can look at their properties as data points. Like if I can replicate that, then I have real data that's kind of like backing up what the hypothesis is there. And so that's a big thing is I didn't know that Michigan, specifically lakefront properties in Michigan, were such an attractive investment in terms of, families just driving to Michigan. And it doesn't necessarily need to be in like any one central location. People will go to different lakes in Michigan. So that was kind of one big insight. So that's where this property is, northern Michigan. It's lakefront, and that's kind of like the backdrop of the deal. Now, why did I want to do a short-term rental? It is not abnormal for a short-term rental to cash flow thousands of dollars in a single month. And that is kind of the appeal of this. That comes with a lot higher risk. It comes with a lot more work. But if you can get a property that's going to cash flow $2,000, $3,000, $4,000, $5,000, depending on the property, it changes the formula for financial freedom, in a way that is meaningful, at least to experiment. I'm not saying I'm going to have one successful Airbnb and that's it. I'm going to quit my job. But hey, if we can get something that's cash flowing $1,000, $2,000 a month, a little bit more, that's something that's worth attempting to do. But it is not without risk. And so the way I de-risk that is, one, I align myself with somebody that is a local market expert and someone that's done Airbnb before. So I think that's kind of one takeaway here. This is a team sport. I didn't know anything about Michigan. I needed to be aligned with someone that knows a lot about the market, specifically Airbnbs in Michigan. So I've done that. The second way that I've de-risked this is you probably have heard about the Airbnb bust. You've heard that short-term rentals are getting crushed. There was a gold rush for short-term rentals in 2021. You could just throw IKEA furniture in any property, throw it on Airbnb, and you were cash flowing a ton. Those days are over. Those days are over. You're not going to just be an amateur operator in the STR space and make a ton of money. You're just not. You're probably going to do worse than long-term rentals. So there's this concept of saturation. Is the market saturated? And one of the STR minds in the space, Kenny Bedwell, he has a company called STR Insights. He always says that a market is not saturated. A bedroom count or a property type is saturated. So what does that mean? That means that in one particular market, right? Let's talk about a lakefront market in northern Michigan. It is entirely possible that there are way too many 2-bedroom Airbnbs. But if you then go to that same market and you look for a 5 or 6 bedroom house, there is probably only going to be a handful of properties that are there in that bedroom count. So again, a property itself can be in a market that is quote unquote saturated, but can still succeed in that market. To kind of bring this back to this specific deal, this deal is 6,500 square feet. So it's a big boy. It is a big property. It is lakefront, right? So it is a prime location. It is literally steps from the water. So it is a great lakefront location. So when people come to this town to stay on the lake, this property is in prime location for that. And there is a built-in amenity in the form of an indoor heated pool. Pools are becoming quite a big deal in the Midwest because not a lot of homes have them. And this is an indoor pool, and it's heated. And so this should help a lot of the seasonality that does kind of trouble Airbnbs in the Midwest during the winter specifically. And then the last thing too, the regulations are a big factor for Airbnbs. And so we called up the actual township and we verified with them what is the temperature, what is the current regulations on Airbnbs. And this is an STR friendly township. And so those are the three ways that we kind of have become comfortable with this idea. And for you, the listener, that's how we want you guys to think about whenever you're approaching a strategy. Outline the risks that are in front of you with this strategy, right? Whether that's long-term rental, mid-term rental, short-term rental. I talked about 3 different risks. I had no local market knowledge. I de-risk that in a certain way. There's literally Airbnbs that are doing terribly right now because they're just a 2-bedroom or a 1-bedroom or even a 3-bedroom house, and people are just choosing hotels, right? So there's a problem of saturation. And so I de-risk that by only focusing on bigger properties and unique properties in locations that will lend itself well to those types of properties, those super properties, as some people call them. And then the last one is the regulations. And I de-risk that by doing the work, doing the research, and picking up the phone and calling the township. Because I think a lot of people are going to do a Google search and nothing is going to be more valid than just calling up the township or the city and just being like, hey, what is the stance on Airbnbs? Are you looking at short-term rentals in a metro area, right? Or are you looking at short-term rentals in a destination type of market? Because for me in particular, I did not feel comfortable. There are people probably making a killing on Airbnbs in metro areas because, you know, people want to stay in Airbnbs sometimes versus hotels, right? But for me personally, I didn't feel comfortable with that because of the temperature of the regulations. Like that economy of the metro area obviously doesn't depend on the Airbnb, right? There are jobs, there's industry, there's a ton of different things. But when we're talking about these destinations, these big lakes, these places where people go to stay to vacation in the summer and in the spring, that's where I became a little bit more comfortable. So that was just a little breakdown of the thought process on the strategy and a little bit of breakdown on why, you know, I felt Airbnb was worth experimenting. And another thing, I said this in a different podcast when we had Steve on, everyone is afraid of Airbnb. I think there's a lot of good reasons to be afraid for Airbnb right now. If you're in a place where regulations is not favorable, if you're just buying a run of the mill and you have a IKEA furniture and designed house, I think there's a lot of reasons to be afraid. But with fear comes opportunity. And if you are entering it at the right time, not just STRs, but any type of strategy. When there's fear, there's opportunity. You got to be fearful when others are greedy and greedy when others are fearful. There's a lot of fear in the Airbnb market right now. And that is what gave me the signal to say, hey, I think now's a good time to attempt to do this, but I want to go about it the right way. So that's a little bit of background on like my thought process of this. And hopefully that's helpful. Now, how do we find the deal? So like I said, I have a realtor in Michigan, but I'm also a part of this coaching program. And the cool thing about the coaching program is everyone is in this program helping each other find deals. That's kind of been what like a very cool part of it. And there's a lot of people in the program that are in Michigan specifically. And so this particular deal was sent to us by someone in the coaching program. Shout out to Jared. He's also a listener of the podcast and he is obsessed. He's actually studying for his real estate license in Michigan right now, but he is obsessed with finding deals. He is like, every single deal that hits the market probably has a million different searches right now on the MLS for that. And he's just sending deals. He knew my buy box, which we'll kind of get into. And he sent this to us. And I was in Mexico at the time for my cousin's wedding. And this deal came across my desk. I was drinking margaritas. I wasn't in the mindset to buy this deal, but it checked all my boxes. It was lakefront. It had all the amenities, right? Indoor pool. And I underwrote it quickly and it hit all my numbers. And we'll go over the numbers more specifically. But I was in Mexico. And so I could have said, you know what? Let me just wait till I'm back from Mexico. Let me just wait till I'm back. But every single deal that I've gotten, I was one of the first people to offer on that property. On all the deals I've gotten, I was one of the first to submit an offer. And that is an insight for you, the listener. If it hits your buy box, if it hits your criteria, you have to pull the trigger because if you just delay it, that property is going to get snatched up. It just so happens we were the first one to offer on this. We're the first ones to offer on it. We had a good offer. And so we can kind of go over the offer right now. It was listed for $799. That was the purchase price. It was listed for $799. And we went right at list. We offered right at list. And it had been listed before at a much higher price than $900. And kind of over time, they took it down and took it down. And that's another factor of the short-term rental market that was kind of interesting to me because a lot of these properties right now, they're bigger purchase prices. Obviously, there's a much bigger purchase price than some of the properties that I purchased in Cleveland. But when you had a property, a good property in Cleveland, that was going to cash flow and it was a nice, clean property, that thing would not sit. That thing would get multiple offers in a single day. It would be done and dusted probably within a couple of days because that's what it is with long-term rentals. People know when they spot a good long-term rental, the competition is fierce. Now, short-term rentals in a high interest rate environment, these things sit a little bit longer because they're much bigger purchase prices. The short-term rental market is a lot smaller in terms of the appetite of the investor because of the higher risk. And so these types of properties, they don't necessarily go the quickest. right? Because of the higher purchase price, because of the high interest rate environment. So we went right in that list. We got our offer accepted. And at that point, it was go time. This is the biggest acquisition that I personally have ever done. And it is a completely different strategy. And so I kind of want to walk you guys through the numbers of what we are expecting this property to do. So we'll kind of go through the financials right now. So the purchase price, like I said, was we offered at $799. But what we ended up doing, we ended up increasing the purchase price to $807, but doing $8K in seller concessions. Effectively, the net impact to the seller is nothing, but you're getting a little bit of help at closing with this structure because we're getting $8K less that we need to bring to the table in terms of closing costs. So that's what we ended up doing. $807 purchase price with $8K in seller concessions. Now, how do we finance this? This is another element, another wrinkle to this that is unique to the short-term rental space. In the short-term rental space, a lot of people use second home loans. Tony J. Robinson talks a lot about this. Avery Carl talks about this. Like, this loan product is available to short-term rentals. This opens up to you lower down payment financing than a traditional investment property. Now, typically this is around 10 to 15%, but this particular lender, 5% down, second home loan, no PMI. So they keep it on their books. You have to have a relationship with the bank, right? So you have to have an account with them with $25,000 in the account. Now, I want to highlight a couple things here, right? Low money down is a risk. Taking this approach, you're not walking into this with a ton of equity. But in the short-term rental space, this opened up a lot of different options for us because we are going to need to furnish this. We are going to need to rehab this. Instead of putting all the money in the down payment, which there would be a sizable down payment if it's 20% down, we are taking the low money down approach, leveraging the financing that's available to us, which I've never heard of this before. 5% down, second home loan, no PMI. Very, very rare loan product. And so that's how we financed it. Now, let's talk the numbers. I think this is probably a lot of the questions that people are having is like, okay, that's a big purchase. How are you justifying this type of purchase for the short-term rental? What do we expect this thing to do? So the underwriting process for short-term rentals is a lot different than long-term rentals. In long-term rentals, you can go to Rentometer, you can go to Zillow. There's a bunch of different tools, and the variance for that is not that wide. You can't do that with Airbnb. You're going to be wildly off. It really depends on the property. It really depends on the bedroom count. It really depends on the amenities. Really depends on the design, right? So there's a lot more work that goes into the underwriting process itself. Because if you're bad at underwriting Airbnb, this thing could be a disaster. You could be wildly overestimating your revenue, wildly underestimating your expenses. So you have to take a lot of care. Now, luckily, this is what I would consider to be one of my strengths, right? Is the number side of real estate investing. I work in analytics in my day job. I take the data very seriously. I always have. And this is the area of this part where I was like, I am not going to mess this up, right? I'm going to be very conservative. I'm going to do everything that all the big STR investors say to do in terms of analyzing the deal. So the first thing that you have to estimate for Airbnb is revenue. You have to estimate the revenue. And the way you typically do this is you look on AirDNA, right? AirDNA is a data aggregator. It scrapes all of the data from Airbnb, VRBO, and basically says, this is what we estimate this particular property to do. It's a pretty cool service, but you can't just take that, plug in your address, and then trust what AirDNA is going to say, because that's not going to work either. AirDNA is a good starting point, but you need to kind of peel back the layers of like, okay, how much can I expect this to do? So what you have to do, you have to build a strong competitive set of similar properties with similar attributes and similar amenities. And so we go through, we try to find a good set of properties that are this size, that have this bedroom count, that have a pool, right? That are lakefront. And you kind of go through that. And in that exercise, you kind of observe this is, a high, medium, low kind of approach of what the revenue range is. And we actually had the benefit of having our Airbnb coach, right, who analyzes a ton of deals, also kind of validate this on his end. We also had literally the head of data analytics at TechVestor, which is an Airbnb syndication. He actually underwrote this property as well. John Bianchi, super smart data mind. He actually underwrote this property as well. So we triangulated all of these different kind of expert opinions. And what we got to is we think that the property is going to do $200,000 gross annually. $200,000 gross through the analysis of having a competitive set of properties, understanding the attributes. So there's a range here. The range was about 175 in the lower end of the range to about 240. And so what I felt comfortable was saying that this property is going to do 200,000. So that's where we're kind of landing with the revenue. Now, we'll run through the rest of the numbers. It's a lot easier to kind of quantify the rest of the numbers. So I'm estimating about a 40% expense ratio for the operating expenses, right? So if that is 200K, that's about 80K in operating expenses, right? And so we're talking about cleaning. We're talking about utilities, obviously, for the Airbnb. We're talking about maintenance. We're talking about all the operating expenses that you typically have for a long-term rental, but also additional operating expenses, right? Because you have the platform fees for Airbnb, the cable internet, repairs and maintenance as you normally would. So you want to kind of take those, and those are the operating expenses. And here's a big thing. Here's a big thing to call out. We are going to self-manage this property. In the Airbnb space, it is prohibitive, typically prohibitive. If you want to cash flow what you typically would cash flow in Airbnb, it is prohibitive to have a property manager because they charge 25% of gross revenue. And in the long-term rental space, that's 8 to 10%. And that is a much more palatable number. But when you're talking about 20% of gross revenue for Airbnb, and these numbers are much larger, the gross revenue, you're talking about 60% of your profit. 20% of gross is 60% of net. So it's prohibitive. And so we are not, in my operating expense, it is not including property management. That's a very important point. So that's a 40% expense ratio. Typically, what I see in underwriting in Airbnb is around 35%. That's where I see most Airbnb people underwrite the expense ratio. So I'm padding it a little bit more at the 40%. Moving on to the debt service. So we had 200K gross revenue, 80K operating expenses, and 70K debt service. So that's just mortgage and interest is our debt service there. So we're, remember to remind the listeners, we went low money down, 5% down, no PMI, but it's a low down payment. And the interest rate is high on this because it is a different type of lending product, right? So it's a high interest. So this is where a lot of risk in the deal sits. We have 200K in gross revenue, right? And we talked about how we got to that number. We have 80K in operating expenses, which is conservative, but we think that is a smart thing to be conservative in this realm. We have the debt service at 70,000. So if you take the operating expenses plus the debt service, that's 150,000 in total outflow to the property. So if you take that, what is left over is $50,000 in net cash flow. Obviously divided by 12, that is a little over $4,000 a month in net cash flow. And this, ladies and gentlemen, I'm not saying this is guaranteed. I'm not saying that there's not going to be variance here. I'm not saying that we're going to get this in year one, but if we can get to this, that is a single property that is on average, right? And there's going to be seasonality here, but on average, cash flowing at $4,000 a month. And we will see, right? There's risk here. There's massive risk here. There's a lot of risk here. And that's what I want to kind of highlight to the listeners here today is that I am taking a calculated risk, but if it does work, it changes the financial freedom formula or the equation in a way where it would take several long-term rentals over a longer period of time to get to that point for this one property. And it's worth the experiment is kind of all I'm saying. It's worth the experiment. And that, to kind of round it out, what is it going to take? You know, what is the upfront capital that it's going to take, the down payment, the furnishing, the rehab that we're estimating, all this stuff, because that is one of the big roadblocks to Airbnb is the upfront capital cost, right? If you're talking about a long-term rental, you're talking about the down payment, you're talking about the closing cost, maybe some light rehab, right? Depending on the property you're buying. But for an Airbnb, you're talking about design, rehab, furniture, and furniture is a big cost. And so what are we estimating for total all-in cost? That's around $200,000 that we're estimating for total all-in cost. Now, that is not a small amount of money. And it is much more than even I myself would typically be looking to place as an investment, me and my wife. And so that is where it came into the equation that said, okay, I'm an investor. How do I problem solve? I brought a partner onto this deal. I was talking to my best friend. He also is in real estate and he's been wanting to kind of like make an investment. And for a lot of the long-term rentals, I talk to people all the time. They're like, hey, do you want to do a deal together? For the long-term rentals, it doesn't make sense, right? I don't need a partner and it's going to take a long time for that to make sense. It doesn't make sense. But for Airbnb, if we are able to generate the profit that I'm expecting to generate, maybe it does make sense, right? Maybe it does make sense to partner. So as an investor, I didn't want to invest $200K of my own capital into this. So I said, okay, like let me bring a partner in. So I brought my partner in, Kevin, into the deal. And the cash on cash return of this, right, for the investor is it's going to be $50K of net cash flow on $200K of capital invested. So that is a 25% cash on cash return. Right. So within 4 years, potentially, if this works out, then we're able to get all of our capital back. Now, those are the numbers at a high level, but I want to stress this. I want to emphasize this. Underwriting is good because you want to know your numbers, and real estate is a numbers game. But I do not think for a second that it's going to pan out exactly the way that I have it on my spreadsheet. I don't think that for a second. I am an investor for the long term, so I know it's going to be a rocky road, especially the first year of getting an Airbnb operational and things like that. If we listed this property on Airbnb, it's a 4-bedroom house, right? But it's a 4-bedroom house in 6,500 square feet, right? And so there are room for more bedrooms in here. There are room for more bedrooms in here. And this property was built in the early 2000s. And I don't think a lot of the interior has been updated since the early 2000s. But to get this property to its maximum potential, we think we need to turn this 4-bedroom house into a 7-bedroom house. And we think we need to kind of update some of this interior. That rehab portion is kind of how we're thinking about allocating the rest of the budget there. Now, this is a piece, and I want to highlight this for the listeners because I think this is very real. I've never done a remote rehab before. And this is probably part of the deal that's giving me the most anxiety because I know that there's a good amount of work that needs to go into it. And even getting to the point of trying to understand the budget, I'm still talking to contractors as we speak, trying to get a firm budget of the scope of work that I have right now. And so I could be off, right? I could be off. I mean, we're going to close on this property, but I could be off. I'm not blind. I'm not blind to the fact that I really don't know what I'm doing in this regard, right? And I'm going to be at the whims of the general contractor that I partner with, the people that I'm working with, and how I manage this. But that is kind of like how we're thinking about it. Now, I've semi-validated this with like high-level conversations, but the contractors still need to get in there, get like high-fidelity bids. They need to actually like visit the property. And I'm actually traveling to the property in a couple of weeks with my business partner, meeting with some of the contractors, doing this. But this is the work, guys. This is the work of being a real estate investor, feeling the anxiety. Let me tell you, I have lost sleep throughout this closing. I've lost sleep. I have almost several times backed out of this deal. Thought I'm over my skis. This is a lot of money to be investing in a deal. I've never done this before. Talking to contractors and I have no idea what I'm saying. I have felt all of the emotions in this deal. But the one thing that kind of brought me back to reality is we got the appraisal 2 days ago. And just for the listener, the appraisal is kind of like the last step of the transaction process where the bank is validating that this thing is worth what we think it's worth so that they can lend up to that amount, right? So they can lend up to that amount. Now, if it appraises below value, then you have a problem. Then you have an appraisal gap. And we've talked about this in past episodes. So this property, the last hurdle to clear was it needed to appraise. It needs to appraise at the 807 purchase price. That is what we were looking for. I got the appraisal back 2 days ago, and it appraised for $987,000. My realtor in Michigan said he's never seen it before, appraisal this high. We'll break this down, but what this means is we bought a property on the market for $180,000 below value. That doesn't happen very often. And I knew that this was a special property. I knew that it had the makings to be $1 million property, but to have the external third party kind of validation of this really brought it back home for me and said, okay, now we have some options because we walked in low money down. But if the appraisal is correct, then we're effectively walking into this as almost as if we put a traditional kind of down payment with the amount of equity that we have in the property now. And so that opens up a lot of different exit strategies down the road. What if the rehab does increase the value, right? What if the rehab takes it above the $1 million mark and adding the bedrooms and updating the interior and things like that? What if it takes it to, even higher? And what if the interest rates come down? And what if we're able to refi into a better loan product at a much higher value? I don't know if it's going to be a perfect cash out refi or a burster or whatever, but it opens up options that we have this equity that we didn't think we were going to have. And so when we got that appraisal, I said, even if this isn't a monster Airbnb, there are exit strategies that are open up. You have to think about all the exit strategies. You have to think about the different moves that you can make. And so that told me right there, despite the anxiety, despite everything, I was like, I'm pushing forward with this deal. We're going to make it happen. And now we're just waiting for the clear to close. I hope this was helpful to you. It is my first Airbnb. I am Jacob. You can find me at Cash Flow Saga. With that, ladies and gentlemen, we are the Financial Freedom Fighters podcast. We will see you in the next episode. Peace.